Welcome to the deep dive.
Okay, so this time you sent us a really interesting mix of documents. We've got financial reports, other materials, all from Hathway Cable and Datacom Ltd.
Yeah, quite a collection. It looks like it spans, what, about 2010 right up to 2024.
Exactly. So our job, our mission, if you like, is to sift through all of this stuff and pull out the really key insights for you.
Basically, we're doing the heavy lifting, trying to give you a solid understanding of Hathway's financial journey, their big strategic moves, governance, the whole picture.
Without you having to read, well, potentially hundreds of pages. We've got annual reports, meeting notices, even a con call transcript in there.
It's a good mix. Should give us a pretty comprehensive view.
All right, let's dive right in. Where should we start? Maybe the early days, around, say, 2010, 2011.
Sounds good. One of the first things mentioned is the reappointment of a managing director and CEO back in 2010.
All right, makes you wonder about the context then. Stability, or maybe some changes were happening. Could be. And interestingly, even back then, they mentioned that the accounts of their subsidiary companies were available for shareholders to look at.
Oh, okay. So some early signs of transparency, maybe,
hmm
making information accessible.
Seems like it. Little details like that can tell you something about the company culture, even early on.
And how were they doing in the market back then? I see a comparison against the NSE Nifty for 2010, 2011.
Yeah, that gives a bit of context, how they stacked up against the broader market index at the time.
We also see mentions of investments in mutual funds around this period.
Mm-hmm. A little glimpse into their treasury management,
Yeah.
how they handled cash beyond just the core cable and datacom business.
And a fundamental point, they state, their revenue recognition is on an accrual basis.
Right, which is standard accounting, but good to see it clearly stated. So they count the revenue when they provide the service, not necessarily when the cash comes in.
Exactly. If you get your cable service in December, they book that revenue in December, even if you pay the bill in January.
And sticking to that consistently over the years is pretty crucial for comparing performance accurately.
Okay, let's jump forward a bit. Say the mid-period, maybe 2013 to 2015. What stands out?
Well, governance-wise, there's the appointment of Mr. Devendra Shrotri as an independent director in 2014.
Ah, yes, I saw that. They gave his term until August 2019 and noted he wasn't subject to retirement by rotation. Independent directors are important, right?
Definitely. They bring that outside perspective, challenge management assumptions. It's a key part of good governance.
And we're talking about shareholder engagement. There are detailed instructions for e-voting from 2014.
Yeah, quite detailed. Specific password requirements, uppercase, lowercase, numbers, special characters, the whole thing.
And they mention the platform, CDSL, and the role of the scrutinizer.
It shows a real effort, even back then, to make it easier, or at least possible, for shareholders to vote electronically and have confidence in the process.
Here's a curious detail. Data on unclaimed shares from 2013-2014. They actually list the number of shareholders and shares involved.
That is interesting. Unclaimed shares. People move, forget they have them. It raises questions about how proactive companies are in tracking those shareholders down.
Yeah, does it show good record keeping or maybe difficulty reaching some shareholders? Hard to say from just the number.
True, but tracking it is the first step, I suppose.
During this time, we also get a clearer picture of their accounting policies, things like finance leases.
Right, which is basically like long-term renting of an asset.
Right.
How they handle subscription income recognition, and also asset impairment.
Impairment being when an asset, maybe some equipment, loses value faster than expected. How they account for that is important.
Absolutely. Understanding these policies helps us understand the numbers they report year after year.
And we see some summarized financial data for subsidiaries around 2014. Not individual details, but totals.
Yeah, things like total share capital, reserves, liabilities, assets, turnover, profit loss for the group of subsidiaries gives a sense of the scale, which is useful given Hathway operated through quite a few different entities. The group's health depends on these parts.
Sticking with governance, there's a list of directors from 2014, highlighting who was independent.
And mention of a code of conduct for the board and senior management?
Plus, a declaration that everyone complied with it. Seems like they were ticking the boxes for governance structures.
And they also mentioned again how shareholders could get hard copies of subsidiary accounts or inspect documents, reinforcing that transparency point.
There was an auditor change ratified in 2015. Edos G. M. Kapadia & Co. came in.
Auditor changes happen. Could be routine rotation, could be something else. It's just another data point to track over time.
We also get a brief mention of loans they secured using fixed and current assets around 2014-2015.
Right. hints at how they were funding things, using assets as collateral for borrowing.
And digging deeper, a later report actually mentions unclaimed dividends from way back in 2010, 2011.
Shows these things have a long tail. Companies have ongoing duties related to past dividends.
Okay, now let's shift gears. Around 2017, 2018, the language seems to change. There's a real emphasis on investment for the future, transforming customer service experience, and cost optimization.
Yes, this feels like a really significant moment. A clear strategic pivot announced in FY 2018.
And the big thing seems to be broadband FTTH, fiber to the home.
Absolutely. Investing heavily in fiber, aiming for gigabit speeds, expanding the network, that's a major strategic bet on the future of internet.
A serious commitment. We also see the appointment of cost auditors, Mrs. Ashok Agarwal & Co., for FY 2018-19.
Right, and the remuneration is mentioned. Bringing in cost auditors suggests a stronger focus on, well, managing costs effectively. Not just the financial audit, but operational efficiency.
Their nomination and remuneration policy is outlined around this time, too. It details how they appoint directors, auditors.
And a committee's involved in reviewing financials, internal audits. It's about getting the right oversight for this new strategic direction.
We also get insights into how they handled intangible assets, things like network franchise rights, software, bandwidth rights.
Crucial assets for a company like this. They talk about amortization.
Which is like depreciation, but for these intangible things, right? Spreading the cost over their useful life.
Exactly. It impacts the reported profit each year.
And more broadly, accounting for foreign currency transactions and goodwill comes.
Forex risk is always there for larger companies. And goodwill. That often comes from acquisitions, representing value beyond tangible assets. How they account for it matters.
We see details of their borrowings non-current, so long-term debt and current short-term as of March 2017 and 2018. Gives a snapshot of their debt levels during this investment phase.
Yeah, helps understand their leverage and financial obligations as they were spending on that FTTH rollout.
Related party transactions are mentioned too. Interest and rent paid to subsidiaries, key managers.
Always something to look at closely. Need to ensure those deals are done at arm's length, meaning fair market terms.
There's a note on the auditor's responsibility regarding internal financial controls.
Basically, the auditors are saying part of their job is to check if the company has good systems in place to ensure the financial numbers are reliable.
We also get a breakdown of how they classify and measure financial assets. Amortized cost, FETPL, FVTOCI.
Okay, getting a bit technical here. FETPL is fair value through profit or loss. FVTOCI is fair value through other comprehensive income.
Right. Different ways to value assets, and it affects where the value changes show up, either directly in the profit loss statement or elsewhere.
Knowing this helps interpret how market fluctuations in their investments might hit their bottom line.
We see examples of other expenses for 2017 and 2018, service charges, bad debts, rent, just the usual costs of doing business.
Helps to see the breakdown, track any big changes year on year.
And there were exceptional items in those years. Things like allowances for doubtful advances, the impact of an arbitration award.
Yeah, one-offs. Important to isolate those when you're trying to understand the core ongoing business performance.
Lease expenses are detailed to cancelable and non-cancelable leases. These can be significant commitments.
Definitely. Understanding their lease obligations gives insight into fixed costs.
And pulling this period together, there's that Q2 FY 2018 con call transcript. Management explicitly links ARPU increases average revenue per user to the investments in digitalization.
That's great context. Direct confirmation from leadership that the strategy they outlined, investing in the network, digital, was starting to pay off, at least in terms of user revenue.
Okay, moving into the next phase, around 2019 to 2021, this seems like another huge shift. We see the term new promoter group and a consolidation offer, period.
Yes, this is clearly a major ownership change, a new controlling entity coming in. That's a pivotal moment for any company.
And we see mentions of things like a private sale of securities clause, non-competition, non-solicitation covenants.
Pretty standard stuff in these kinds of deals. The new owners want to ensure a smooth transition and protect their investment.
Importantly, they state that related party transactions, even with this new promoter group involved, were still done on an arm's-length basis.
Crucial reassurance for other shareholders and the market. Maintaining that transparency during an ownership change is key.
We get the independent auditor's report for FY 2019, giving their opinion on the financials under this new structure.
The auditor's sign-off is always a critical piece. Gives confidence in the numbers.
There are details on investments and loans as of March 2019. Looks complex associates, firms where subsidiaries are partners, provisions for impairment.
Yeah, it paints a picture of a group with quite a few interconnected financial relationships. Understanding where the money flows and the risks is important.
The rights attached to equity shares are laid out too. Basic but essential info for shareholders.
Absolutely. Voting rights, dividend rights, etc.
We see details of provisions money set aside for expected future costs and other liabilities as of March 2019.
Gives a sense of their known future obligations at that point.
And there are summaries comparing carrying values, so book values, with fair values or market values for financial assets and liabilities in 2018 and 2019.
Helps assess if the balance sheet reflects market reality, more or less.
We also see discussion of liquidity risk management, basically ensuring they have enough cash to pay bills as they come due.
Always critical. Especially after big investments or ownership changes, you need that cash flow managed well.
The audit report for FY 2019 had an emphasis of matter. It pointed towards deferred tax assets and those exceptional items.
Right. Not necessarily a red flag on the numbers themselves, but the auditors highlighting specific areas readers should pay attention to. Deferred tax assets are essentially potential future tax savings.
The list of related parties grows, including fellow subsidiaries, joint ventures, particularly mentioning the Reliance Group as the new promoter group.
Makes sense. Provides context for any transactions within that wider group.
Operationally, in FY 2019-20, there seems to be a push on back-end IT, improving customer connections, online portals, real-time activations.
And the launch of MyGeo and the TRII channel selector apps looks like leveraging the tech capabilities of the new promoter, wouldn't you say?
Seems likely. And they also talk about strengthening the broadband offering, aiming for seamless connectivity.
Reinforcing that earlier FTTH strategy, keeping the focus on high-speed internet.
A secretarial audit for the year ending March 2021 confirms compliance with laws and good governance practices.
Another layer of independent checking. Good to see.
We get summaries of the governance structure roles of the board, committees like nomination and remuneration, stakeholders relationship.
Standard components of corporate governance outlining who's responsible for what.
There's also mention of a framework for monitoring subsidiaries, specifically calling out Hathway Digital Ltd.
Makes sense to have specific oversight for major subsidiaries within the group.
Accounting policies mentioned here include how they treat non-current assets, held for sale, and discontinued operations.
So how they account for parts of the business they plan to sell off separates it from ongoing operations.
Details on deferred tax assets and liabilities again for March 2020 and 2021, tracking those potential future tax impacts.
Yep, standard disclosure.
They explain the fair value hierarchy for financial instruments, basically how reliable the valuation method is. Level 1 is best, based on active market prices.
Adds transparency, lets you know how much estimation is involved in valuing certain assets or liabilities.
And a contingent liability crops up. Show cause notices from the Department of Telecommunications about ISP license fees.
Right. A potential future cost, depending on how that dispute with the regulator gets resolved, that's a significant risk to flag.
They talk about managing foreign currency risk through hedging.
Using financial instruments to protect against losses if exchange rates move against them. Standard practice for companies with Forex exposure.
And they even show the unhedged exposure as of March 2020 and 2021, the risks that remained after hedging.
Good transparency there. Shows the residual risks.
Related party transactions with the new promoter group, Reliance entities, are noted again.
Expected, given the ownership. Disclosure is key.
And finally, for this period, web links for their CSR committee details and CSR policy, showing their public commitment to corporate social responsibility.
Making that information easily accessible. Good practice.
Okay, let's bring it closer to the present. Around 2022 to 2024, what themes emerge?
Well, there's talk about the rise of connected TV sets, expected growth by 2025.
And how that might shift the business model for local cable operators, the LCOs, maybe towards a hybrid approach.
Exactly. It ties back to those FTTH investments, right? Positioning for a future where TV is delivered over high-speed internet, possibly alongside traditional cable, adapting to how people watch things now.
They also mentioned focusing on product strategy, go-to-market plans, new initiative like QR code payments, next-gen set-top boxes.
Sounds like efforts to improve the customer experience and compete better, especially against the streaming giants, the OTT platforms.
We'll get depreciation, amortization, and impairment figures for 2019 and 2020, just tracking the ongoing cost of using their assets.
And any write-downs in value. Standard financial reporting.
More details on other expenses for those years, too. Continuing to monitor operational costs. Actuarial valuation assumptions for employee benefits pop up. This relates to things like pensions, gratuity obligations.
Yeah, how they calculate those long-term promises to employees. Uses complex assumptions about inflation, life expectancy, etc.
Sensitivity analyses are mentioned how changes in foreign exchange rates or interest rates could impact their financials.
Shows their awareness of market risks and the potential impact on the bottom line.
We see allowances for bad and doubtful loans and details on net advances, receivables, payables, managing credit risk, and working capital.
Core financial management stuff. How much money they expect not to collect, how efficiently they manage day-to-day cash flows.
There's another note about the auditor's responsibility, this time regarding other information in the annual report.
Right, clarifying that auditors check the main financial statements thoroughly, but other parts of the report, like management commentary, get a less intensive review.
They mention compliance with transferring unclaimed amounts to the Investor Education and Protection Fund, or IEPF.
Following the rules designed to protect investors' unclaimed money.
Their policy on capitalizing borrowing costs is explained.
Deciding when interest costs become part of an asset's value on the balance sheet instead of just an expense in the profit and loss, usually for big projects that take time to build.
Details of other financial liabilities for March 2019 and 2020, just a fuller picture of what they owe.
Yep.
We see the fair value of plan assets for employee benefits. So, how the investments funding those future pensions are doing.
Important for knowing if those benefits are adequately funded.
And interestingly, a mention of regulations that were not applicable in a certain year helps define their specific regulatory environment.
Provides useful context, clarifies which rules they don't have to follow.
Recent reports note appointments of key management personnel and directors, shows ongoing evolution at the top,
Leadership changes are always worth noting.
and a highlighted increase in mutual fund investments in 2024.
Oh, could suggest they had more cash on hand, or maybe a change in how they manage their short-term investments.
Financing arrangements and credit lines are mentioned, their access to borrowing.
Important for financial flexibility, future investments.
There are mentions of some companies being struck off the register and related receivables. Maybe some old bad debts or difficult business relationships being dealt with.
Could be. Cleaning up old issues.
Revenue recognition from contract liabilities, basically. Unearned revenue and how that's changed.
Shows the timing difference between getting cash from customers and actually delivering the service and booking the revenue.
How they account for their share of losses in equity accounted investments is noted.
So companies where they have influence but not control, their share of those results affects Hathway's bottom line.
A breakdown of intangible assets over several years, tracking things like network rights, brand value.
Shows the trends in these important non-physical assets.
Exceptional items again in 2022 and 2023, impairments, settlements, those one-off impacts continue.
Need to keep adjusting for those when looking at underlying performance.
And we get basic and diluted earnings per share figures for recent periods.
Key profitability metric for investors, obviously.
That contingent liability regarding the Department of Telecom AGR demands comes up again. Still ongoing, it seems.
Yeah, some of these regulatory issues can drag on for years, remains a known risk.
Recent reports also detail remote e-voting options for different shareholder types. Continued focus on shareholder access.
Making it easier for everyone to participate. Good governance.
An interesting note about the board making decisions unanimously in recent reports.
Could indicate strong consensus, or maybe just the nature of the decisions being made.
And finally, reiterating their belief in best practices for corporate governance and having a code of conduct.
Reinforcing that message of ethical operations right up to the recent documents.
So, wow, okay. That was a lot, but pulling it all together from those sources, you really trace Hathway's story, don't you?
You really do. From those early days, the transparency hints, then that big strategic bet on fiber and digital.
The major ownership change with the new promoter group, the financial strategies behind it all, and these ongoing regulatory things like the DOT issue.
Exactly. By weaving together the threads from all those different reports and documents you sent, you get a much richer, more concise picture than reading any single one in isolation.
And hopefully it saves you, the listener, a ton of time. That's the whole point of the deep dive, really, getting you up to speed quickly on complex stuff.
Absolutely. Synthesizing it all into the key takeaways.
Okay, so one final thought to leave you with. We've seen Hathway invest heavily in FTTH, position for connected TVs, think about hybrid LCO models. Given all that and the competitive landscape, what do you think the next big strategic pivot might look like for a company like Hathway?
That's a great question. Where do they go from here? What are the next big challenges or opportunities on their horizon? Something to mull over.
Definitely food for thought. We hope this deep dive into Hathway has been valuable. If there are other topics, companies, or sets of documents you'd like us to tackle, let us know.